This confirms everything. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we just got a report out of the Federal Reserve that confirms everything we talked about in yesterday's show and how the banks are driving a big slowdown in consumer credit and demand and putting the economy on pace for a hard landing in the second half of this year. Before we get to that story, we're going to take a look at Visa and Mastercard, which are both validating the slowdown in consumer demand and credit. Plus, we're going to take a deep dive into the Federal Reserve Chairman Powell's recent talk yesterday and how he's got it completely wrong. Plus, we have a sponsor for today's show. I'm going to give you 6 reasons why you may want to add this stock to your portfolio, including some massive insider buying, plus a stock chart that looks like it's about to break out. Stay tuned to the end of the show for more information on our sponsor. Let's go to Bloomberg, where we picked today's story up with a headline: Visa, Mastercard see card spending slow as inflation persists, but maybe even they've got it wrong. Spending on Visa's cards climbed 1.7% to $3.01 trillion in the company's fiscal first quarter, missing estimates of $3.16 trillion. Mastercard volumes jumped 11% to $1.73 trillion, also missing estimates. Now, what we should take away from this initial look is, in a booming economy, what we should see is in persistent and expanding demand for credit. So the fact that we're missing estimates here aren't a huge deal, but when we get into the deeper look at this, it'll start to make sense. So far, both companies have said inflation hasn't weighed on consumers' overall spending patterns, but maybe it actually has. We'll show you and make that case here in a moment. Instead, card customers have shifted their spending to lower cost items or generic brands, which is exactly what you see during periods of high inflation. It says, look, we can't afford the brands we want, so we're going to start spending on brands that we would rather not use, but we need, and at lower price points. So again, we're starting to see the case that consumers are indeed being hurt by inflation, and not just a little bit, by a lot. The two companies have said they continue to get a boost from spending on travel and dining out with pandemic-related restrictions easing globally, and there's some truth to that, but here's the bigger picture. I want you to see the consumer price index that's in blue against advanced retail sales in red, both on a year-over-year rate of change and both on the same side of the chart, because what I want you to see is during expansions, retail sales actually are driving at a higher rate than you see inflation. As you get into recession, what do we start to notice? What happens? They start growing at the same pace, indicating consumers can handle higher prices. And as we head into a recession, we note that inflation stays higher than retail sales. So let's go to the next series here where we see going to the great financial crisis. Now look what's happened since. In 2018, we see in 2019, the economy slowed, and notably, we see the same trend happen. Retail sales starting to grow at about the same pace of inflation. If not for the pandemic, we would likely have a recession, but look what's happening now. So they're making this case that, it's not really a big deal. We're not seeing any downturn in demand, but the data says that we are seeing a downturn in demand, and it's right there before you. Still, investors have grown increasingly worried that higher prices will ultimately force consumers to pull back on spending, a move that would cripple revenue for both networks. And now we fast forward to our lead story, which says, yes, this is happening. It confirms everything we said yesterday, that the banks are trying to restrict credit, has nothing to do with the Fed. And remember, in a debt-based economy, we need consumer credit to expand. If it's expanding, the economy is growing. You see it slow down, the economy slows. You see it contract, well, watch out below. Let's go to Bloomberg, Zero Hedge now, where we get our lead story. As U.S. consumers hit a brick wall, December credit growth craters as interest rates soar. Late on Tuesday, the Fed published its latest December consumer credit report, which found that in December, total U.S. consumer credit increased by just $11.565 billion. Now, that might sound like a lot, but get this. That's a 65% drop from November's upward revised $33.1 billion print, but also a huge 50+ miss relative to consensus expectations. So what are we seeing here? What should we expect to see is as banks tighten credit, we talked about yesterday, the knock-on effect should be that consumers now are charging less. There's another factor as well. We've been talking about the personal savings rate being at very low levels, near all-time low levels. And so what happens going into periods of high inflation, consumers will use their credit cards, but as they draw down their savings, they all of a sudden switch on that and they start then prioritizing bringing their savings back up and their use of credit down. And that's what tilts the economy into a slowdown, which points us to the second half of this year. Here we can see on this chart, total consumer credit owned and securitized in red, that on a year-over-year rate of change against the net percentage of domestic banks tightening standards. We're going to use commercial industrial loans again, only because we still have the best and longest set of data on this from the St. Louis Fed database, but it still tells us what we should expect to see. Periods where the banks are easing credit, which is under the horizontal black line, demand for credit rises. When banks start tightening credit, demand for credit eventually starts to slow. You see it pop up during and going into the recession, and then credit comes crumbling down. We see that over and over again. And here we have the case where banks are driving lending standards way up, back to levels consistent with recessions. We should see consumer credit fall, and we are. What caused a sharp slowdown was traditionally increased anywhere from 20 to 30 billion. Well, that came from revolving or credit card debt, which increased just 7.2 billion in December. And that is what we've been talking about, is now consumers are going to have this shift. Let's look at the savings rate and see if this validates what we just said. And sure enough, going into a recession, you see in red the personal savings rate. It starts to get down and stay at relatively low levels. The initial reaction is the use of credit cards. Here we see in blue credit cards and other revolving plans on a year-over-year rate of change. At some point, consumers realize that they need to bring their savings rates back up, and all of a sudden we eventually start to see a slowdown in credit usage, and then it comes crashing down. We see that here going into the pandemic. The same relationship was starting, but look at now, we have the savings rate extremely low levels, so you can only imagine that people are going to prioritize saving and cut back on their credit. Well, that's what we just saw. And the real driver behind the hit, non-revolving credit, which rose to just 4.4 billion compared to the 7.8 billion increase in November and the near 17 billion long-term average. So what we're seeing here is a broad picture of a decrease in consumer credit usage, and that is a huge indicator that tells us where we're headed. Now, we're not seeing the banks changing their positions. We didn't hear that during earnings reports saying, hey, we're going to start easing conditions. No, we're hearing them tighten them because delinquencies are rising. So it all follows the narrative. Second half this year, headed into the recession, and the Fed, well, as you know, they got it wrong. Fed Jerome Powell braces for longer inflation fight amid hiring surge. A government report on Friday showed that hiring accelerated in January was certainly stronger than anyone I expected, said Mr. Powell. He says it also kind of shows you why we think this will be a process that takes a significant period of time. So again, I want you to see the denial out of the Fed chief here saying, look, we're not convinced. We think the labor market is what matters here. What they can't see is that prices are too high, consumers can't afford them, and they can't get the credit to buy them if they wanted them because of the banks. So you start to see that the real issue here is the economy is not as strong as everyone suggests it is. The process of lowering inflation to the Fed's goal of 2%, quote, is likely to take quite a bit of time. It's not going to be, we don't think, smooth, although we'll say that I think he's wrong on this. It's probably going to be bumpy. The expectation that inflation will go away quickly and painlessly is not the base case. The base case for me, Powell says, is we'll have to do more rate increases, and we'll have to look around to see if we've done enough. Market says, no way. Look at this chart here. Consumer Price Index against U.S. regular all formations gas price says that we are about to see inflation follow with a lag gas prices straight down to about 2.5%. And we have some new data that just came out right before we recorded the show that actually indicates that demand for gasoline is falling. Let's take a look at this chart here. Here what we see, gasoline inventories up 5 million last week. Distillate stocks or jet fuel up almost 3 million. Crude oil inventories up a little over 2.4 million. So what you're seeing in the energy markets is validation. Demand is coming down. We're seeing it across the board. If we see gasoline prices further fall here, that year-over-year rate of change is going to continue to drive into deflationary setup, particularly by the summer, suggesting that not only is Powell going to miss his 2% target, he's going to overshoot it to the downside and force him to cut rates far sooner than 2024, which is what he said is when he thinks inflation will hit his target. And now let's talk about our sponsor for the day's show. It's Biosig Technologies. They're a medical technology company. I want you to take a look at what's going on with insider trading on this. You see a lot of demand for shares, and wait till we take a look at the chart setup. It's going to blow you away. Let's take a look here. Let's head over to their website, biosig.com. We'll put a link in the description and a pinned comment so you can do your research here. The symbol, put this on your hot list, BSGM. They're NASDAQ listed. What we notice, Biosig is trying to establish a new standard in cardiac care, and they've got some phenomenal technology that they're using to do that. They're a digital signal processing company that unites expertise in medical engineering, intellectual property, and workflow to deliver superior intracardiac signals with unprecedented precision. Their technology provides a new level of clarity and resolution and arrhythmia identification and visualization, empowering physicians with actionable insights. And I want you to understand, this is going to be huge because you think about the picture here. Who are their customers going to be going forward? You have this big wave of baby boomers heading into retirement. They're going to need regular checkups on their hearts. Physicians are going to be looking for the latest technology to do that, and they're going to be looking to Biosig technology for that. Again, symbol BSGM. Now let's talk about the opportunity from the stock position as insiders have been acquiring shares of this little-known medical technology stock. I'll put a link to this report also in the description below. Again, add to your hot list, BSGM. We'll look at the charts here in a moment. But let's take a look first at 6 reasons why Biosig Technologies could witness unstoppable growth over the next 12 months. Well, reason number 1, we see in the last 6 months, company insiders, including the CEO, CFO, and COO, have all acquired shares of Biosig Technologies, but get this, at a much higher share price than they're trading now. That puts a lot of confidence of where they think this is going. We'll look at that here momentarily. Reason number 2, in a recent research report, Taglich Brothers analyst John Nobile has signed a $1.50 target and maintained coverage on Biosig Technologies. Again, symbol BSGM. I think he's actually underestimating where it goes. When we get to look at charts as we like to look at them, I think the upside's quite a bit higher than he's estimating. Insiders have been acquiring shares of Biosig Technologies. Here we can see, according to tipranks.com graph below, you can see the increase in insider transactions. But while it appears they are buying at the low in terms of price, well, they're actually buying where the stock is low, but the price they're paying is even higher. Here you can see they're paying somewhere around 86 cents on the low end, over $1, upwards of $1.18 on the high end. So here we see anywhere from 83 cents to $1.16. Even though they're buying the stock where it's priced at a low, they're paying a much higher price. There's confidence about these insiders and what they're doing here. Again, all of that will be linked in the description and in the pinned comment for you to follow up on. Reason number 3, the company recently signed a master research agreement with Cleveland Clinic to explore expanded applications for its digital signal processing technology. And the company's first product, Pure EP System, is an FDA 510K cleared non-invasive Class 2 device that provides superior real-time signal visualization, allowing physicians to perform insight-based, highly targeted cardiac ablation procedures with increased procedural efficiency and efficacy. I struggle with that word, but let's continue on because we know there's more reasons, including those charts, that we need to take a look at here. Number 5, market growth. The global electrophysiology market is expected to exceed more than $16 billion by 2028 and is growing at a compounded rate of 11.2 CAGR. And according to barchart.com pricing, if Biosig Technologies, symbol BSGM, climbs back to its 52-week high of $2.46, which I think it could get there, I'll make the case for you, back on January 5th, 2022, after bouncing off its 52-week low of 0.2514 set on November 9th. They cap off a nearly 878% move. It's not expected, but the potential should be noted. And now let's look at the chart, because I think this is a setup that you're really going to like to see. Now here we've got the maximum 5-year chart. Of course, the company doesn't go back that far, but I want to point out the volume profile. Look at this at 82 cents. You can see where most of the shares in the history of the stock have been traded is down below here. So there's been a lot of shares being traded. Now let's zoom in. Here you can see now on the 1-year chart, and then when we look at these insider trades, remember, they're buying the price down here, but they're paying more. That as insiders, they have to pay that higher price. So you see down here at 43 cents, there's a lot of buying demand, but look at this. You see it's hitting overhead resistance right where this volume profile is at, and that's the key point. You can see it bounced up here and hit resistance going back around May, in the middle of May. It came back around August, hit it again. Now it's tagging it again. If it can break out here, now mind you, the analyst said it gets up here to around $1.60. Let's make the case now where it can go even higher, because there is a little bit of volume here when this thing, should it break out to the upside. But notice how there's very little volume trading in between here. That's where I think you get the case somewhere around this $2.20 to $2.40, where you see a next stage of volume, which could be the place that where it slows down. But I think that's the opportunity there. This thing is knocking on the door, looking to break higher. Again, remember, Biosig Technologies, do your research, put them in the search engine, symbol BSGM. Again, before you do any purchasing, remember, use your risk capital only, and make sure you do your research into the stock, the company, and the symbol BSGM. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.